Okay, guys, we're going to go ahead and get started. Game plan for today is to jump in, start with chapter 18. Start with chapter 13, get into chapter 18, and we'll see how it goes. We may actually be able to crack into chapter 24 as well. Before we do that, notice the screen is up. There were a couple of questions from last time that, many people may, enjoy a nice sunny day. I think about accounting on nice sunny days. And so I was thinking about some of the things that we were talking about. I'm like, okay, I have a couple points that I want to make about a couple of the questions that were asked after I thought about them a little bit more, after I did my accounting meditation the other day. What was your name again, sir? Huh? Peter. You had asked, what happens if a company books an account receivable and they don't collect on it? Okay, and I kind of started on that, but after I thought about it, I'm like, I didn't fully answer that question. Okay, so I want to go into that a little bit more. So let's just say I'm a company and I debit accounts receivable for $100,000 because I provided the service, just making the number up, and I go ahead and I credit sales $100,000. And don't worry about cost of goods sold and inventory. We just want to focus on the sales portion of that. And this notion of recording bad debt expense. I think that we had mentioned that if, say, 2%, just to use a number, of the sales were determined to be uncollectible, we take the $100,000, multiply that by 2%. Somebody help me with the math on that. That's what, $2,000? Okay, that we would determine to be uncollectible. Now, when the company does this, they do this based on an analysis of what their experience is how often they don't collect. They may do something called an aging, where the more delinquent the receivable is, the more likely it is they're not going to collect, and they come up with an estimate. Okay, so let's say their estimate was $2,000. At the time of the sale, they would debit bad debt expense for $2,000 and credit the allowance for doubtful accounts. I'm just going to write allowance here for $2,000. Okay. Now, when they do this, and I'm just going to tee up the allowance, the credit to $2,000, and I'm going to tee up the accounts receivable for $100,000. Okay, and they would go ahead. I'm just going to erase this journal entry now that I've teed these up. They would go ahead at that point, prepare the income statement, and on the income statement, they would show revenue of $100,000. They would show, assuming this was the only transaction that happened, they had an account receivable, they had a sale. Okay, so be consistent, call it sales. $100,000. They had the bad debt expense of $2,000. Bad debt expense is an expense, so their net income would be how much here? How much would the net income be? Revenue minus expenses is net income. Hello, what would be the net income? Everybody? $98,000. Okay. Now, when they prepare the statement of retained earnings, beginning balance, I'll assume they just started business. We add the net income of $98,000. No dividend here. So the ending balance is $98,000. We prepare the balance sheet, and we would show what? We would show assets, account receivable of $100,000 less the allowance of 2,000. So the net account receivable is 98,000, right? It's a contra asset. The allowance is a contra against the asset, right, of 98,000. And then in my stockholders' equity, I'll just write it down here, I would have retained earnings of 98,000 in the balance sheet balances, right? Okay. When I prepare the statement of cash flows for and I'm just going to worry about the operating section. Okay. In the operating section, what do you start with? Always start with net income. Net income is what? 98,000. Okay. Then what? Then and the accounts receivable increased. So if it's an increase, you do what? You do the opposite. So the increase in AR would be a subtract because it increased. And then, like depreciation, and I shouldn't have erased the journal entry, but like depreciation, bad debt expense okay, there's a journal entry for the bad debt expense. Bad debt expense is an expense that doesn't use cash. Depreciation doesn't use cash. Bad debt expense doesn't use cash. We just set up an allowance, don't we? So no cash went out, just like with depreciation. So you would add back the bad debt expense of 2,000. And when you do, cash provided by ops is zero. And indeed, cash provided by operations was zero. Even though I showed a net income of 98,000, no cash has come in, right? Okay, now, what happens? You say, but what happens if they don't collect on these accounts receivable? What happens if they don't collect, say, of this 2,000 they put in the allowance? Let's say they find out someone says, hey, I can't pay you $500. At that time, and this could be year 2 now, in this little year 2 of the company, right? At that time, they debit the allowance for $2,000 and credit the account receivable for $2,000, or no, not 2,000, but what I say, 500? Because the person told them they can't pay. When they credit the account receivable for 500, what's the balance here now? 99,500, if I'm doing my math right in my head, which I don't like to do, right? And I debit the allowance. Now the balance here is, doing the math in my head, which I don't like to do, so I'm asking for confirmation, would be 1,500. Okay. Now, when I prepare the income statement, why do they call it the income statement? Because we show net income. How do you calculate net income? Revenue minus expenses. If the only thing that happened was they made this journal entry in year 2, they had a receivable and the person told them they can't pay, so they wrote it off, then what's my revenue? I love it. I love it. I'm like the pitcher that winds up, acts like I'm going to really throw a fast pitch, and then I throw a nice little lob ball and the batter swings and misses 3 times at the same pitch. What's the revenue? The only transaction I did was I debited this allowance, which is a balance sheet account, and I credited the account receivable, which is a balance sheet account. What's my net income? What's my revenue? 0. Good, thank you. He's like, calm down. It's 0. What's the revenue? 0. Expenses, what? 0. Net income is 0, right? Okay. So now when I prepare my statement of retained earnings, beginning balance is 98,000. Add net income, which is 0. Subtract dividend, which is 0. Ending balance is what? 98,000. Right? Okay. When I prepare the balance sheet, my assets, do I have any assets? I have accounts receivable. How much is the account receivable? How much is the account receivable? How much is the accounts receivable? Come on, guys. Accounting isn't something that you float in and out of. Stay with it. What is the account receivable? 99,500. What is the allowance? How much? 1,500. Good. The allowance is a contra account. What's the net account receivable? How much? 98,000 is the net account receivable. Same thing it was last year. The net account receivable in year one was, where'd my balance sheet go? Was 98,000. It stays the same. What has changed is I'm showing you that there's been what? There's been a write-off, hasn't there? One of the accounts receivable, but I recognize the impact on my income statement in the year that I make the sale, so that I'm matching this bad debt expense with the what? With the sale. So what caused that expense was the fact that I offered credit sales in that first year, right? Okay. Now, when I prepare the statement of cash flows, what's my net income? Net income is what? 0. And maybe I should have called it net account receivable. In my first one, I subtracted the bad debt expense right there. I could have just said the increase in account receivable net was 98,000 and the thing would have balanced. I added back the bad debt expense. I could have just said my increase in net accounts receivable was 98,000, and then I would have done what? Subtracted that increase, the net account receivable increase. So I could have said what? Instead of adding back the bad debt expense the way I did, I could have said what? Increase in net account receivable was 98,000. Right, it went from 0 to the net account receivable up here was 98,000. So I could have just called it out that way. Increase in net account receivable was 98,000. I would have subtracted that. Cash provided by operations would have been 0. Okay. So if I sit here now and I say what? Change in net accounts receivable. What's the change in the net account receivable? What's the change in the net account receivable? Was 98,000? 98,000, right? So the change in net account receivable, I heard somebody say, right, is 0. So the cash provided by ops is what? Is 0. So they're not collecting on the receivable. And so what's happening? It's really not having an impact on the balance sheet net. It's not really having an impact on the statement of cash flows net, right? Okay. Now, this idea, though, that this net account receivable is staying at 98,000 over 2 years, okay? If you were to sit there and take the average net accounts receivable of 98,000 over 2 years, 98,000 plus 98,000 divided by 2, because I want the average, equals what? 98,000. So the average account receivable is sitting there at 98,000. And if you sit there and you say, well, it's staying at 98,000 year over year, and the revenue is what? Sitting here at, my sales is sitting here at what? At 0 in year 2. That means it's what? It's holding at this 98,000 over 2 years. It's taking them 365 days to collect their account receivable. That's not a good sign. And as an auditor, I would start to take a look at it and say, well, look, they're not generating any sales, they're not generating cash, I should say, by operations. The receivables are sitting there outstanding year over year. What's going on? Do I have some sort of fraudulent sales being reported? Are they having such hard time with their customers that they're not able to collect their receivables? And you would start to ask those kind of questions. Okay, so just getting to this idea of not collecting, even though the impact we can see is sort of like a who knows on the receivable, we're going to start to get into accounts receivable turnover in chapter 13 here in a minute. That analysis could start to trigger some of the questions that you were asking. Thus, when I was thinking about your question, I'm like, well, let me get into it a little bit more as to how we would get to your point. They're not collecting on the receivables. Question? Yes.
What if the amount that company cannot receive exceeds the initial allowance?
The amount that they need to write off exceeds what was initially put in the allowance? Is that what you asked me? Well, let's say this whole little thing continues. And then one day, somebody comes and they say, you know, I can't pay you $2,000 worth. We only have $1,500 in the allowance. And we want to write off that receivable. So when we write off the receivable, we'll still credit the allowance for what? I mean, credit the account receivable for the full, what did I say, $2,000? Let's use a different number. Let's go crazy. Let's go crazy. They say, hey, I can't pay you $3,000. Now, when I write off the receivable, I have to debit the allowance. How much is in the allowance? $1,500. So I go ahead and I say, well, I'm going to debit the allowance full $3,000. Let me make the number $4,000 just so it, sometimes when you do these numbers, it'll create a new number that might be confusing. So you go ahead and you credit the account receivable, you debit the allowance for $4,000. When I debit the allowance for $4,000, what's the balance in the allowance now? What's the balance in this account, guys? We're to a point now where you should be reading T accounts like a true accountant. What's the balance in here? How much? $2,500, but it's a $2,500 what? Debit balance, isn't it? In effect, it would add to the account receivable at a time when I'm trying to do what? I'm trying to bring the account receivable down because of the write-off, right? The net receivable would go up. Meanwhile, it should be going down, shouldn't it? So what I would do at that point is I'd say, well, since I need to at least zero this out, I need what? I need a $2,500 credit to the allowance. That'll make it zero. And so if I go ahead then and I credit the allowance for $2,500, I have to debit something, don't I? Do debits have to equal credits? I have to debit something. I'm supposed to debit at that point bad debt expense. You say, well, wait a minute now. You're debiting bad debt expense. Meanwhile, you haven't had any new sales. Why are you debiting bad debt expense? And the answer is that's a change in accounting estimate. And FASB, I point up because FASB's God, FASB tells us if you have a change in accounting estimate, you go with that new estimate in the period that you make that estimate, and you do not go back and restate, you just roll with it. Now, I think I talked about the situation where the banks were putting more. Some of the banks I was looking at in that particular assignment were putting more in the allowance so that later on they could look and go, oh, looky, too much in the allowance. Let's take some out. And then you would have credited bad debt expense and you get to report less expense, higher net income, higher retained earnings, higher stockholders' equity, more value to the company in the periods when you choose to make that happen, that's a no-no. The banks didn't like it when I told them that's a no-no. So then a little bit later, the American Banking Association took our report and wrote in their paper, their rag, about how GAO is prescribing cookie-cutter approach to taking an allowance, and the people in my office started laughing at the report. Ha ha! The American Banking Association called you out and said you're trying to cookie-cut the allowance, and I'm like, good! I'm glad that trade rag doesn't like what I'm doing, because that means I hit a nerve with them. I'm glad they don't like it. Little did they know they'd all be dead now, and I'd get to talk to people at Stanford about it. I don't know if they're dead. Okay, so that's kind of the thought process that started to hit me about mile 5 in my run the other day. I was like, why did Peter ask that question? It's making my hamstring hurt. Now, is that okay? We're good? Any question on that? Okay. Now, the other thing that came up was this notion of, why does a company invest in, say, equipment for, I don't know, let's use some different number, $800,000. And I think the comment was made is as soon as they pull this equipment off of the showroom floor, it's going to be worth less. Now, companies don't go and buy something like an excavator, one of the a backhoe, like these big giant machineries, saying, hey, I'm going to roll out of the showroom floor with this excavator, and man, I'm going to be looking good out there, and in a couple of months, somebody's going to go ahead and pay me $900,000 for this fancy excavator. That's not why they buy it. They buy it because they have done some sort of analysis that tells them that they are going to be able to derive some future economic benefit off of that thing. When they make that decision, they look at things like, what are the cash flows that are going to come from this thing? And that's how I should value it. Now, what FASB tells us is when a company purchases an asset like this, they are to pretty much annually do an evaluation to see if there has been impairment on that asset. And one of the methods that they will use that we'll talk about if we get to chapter 24 today or next time, one of the methods they may use is discounted cash flows. They look at the money that they're going to make on it. Now, and they roll it forward and they say this is the money we're going to make over the next 5 years. They have to come up with the present value for that. They compare the discounted cash flows, the present value, to the carrying value of the asset. And if those discounted cash flows are more than the carrying value of the asset, they don't have to do anything, because they're saying the carrying value of the asset, we're going to recover that. If they had discounted the cash flows, and let's say the present value of those cash flows came to be $750,000, they're like, uh-oh, we have impairment. And at that point in time, they would go ahead and they would do what? They would debit impairment loss for, what did I say, it was $700,000? Was the discounted cash flow? Debit impairment loss and credit the equipment for $100,000 to show that that equipment has had impairment. Rule of conservatism, write it down to that lower amount. So they look at the future discounted cash flows. They come up with what is the present value of those cash flows compared to the carrying value. If it's more, they're done. They don't have to take any impairment. If it's less, then they would have to go ahead and take the impairment. Now, that's assuming that they're going to be using the asset to generate future cash flows, right? FASB says that what entities should do is they should do that analysis based on the highest and best use of that asset. Now, if they said, well, we're holding this for resale, we're going to sell it to somebody else, then this notion of, well, you know, as soon as you drive it off the showroom floor, it's worth less or something, then it might start to become relevant. But assuming they're going to be using it in their operations, generating cash flow from it, discounted cash flow would be the approach. So we need to get away from this idea that, you know, you purchase an asset and, you know I use the example of a car driving it off the showroom floor in our little DJ Pizzazz, but that's not how entities decide to buy assets. They decide to buy assets because they've determined they have some future economic benefit to that, often thinking about the cash flows that will come from that. What was I going to say additionally there? Well, I can't remember. There was one other thing, but I can't remember what it was. Question?
You said carrying costs or carrying costs?
Carrying value.
Oh, carrying value.
Carrying values. For example, this equipment is $800,000.
Yeah.
Which name again, sir?
Jamie.
Jamie, let's say, oh, Jamie's crying. You never heard that, right? Okay. All right, so never mind. 30 years ago, the whole room would have gone, yeah. Okay, so what happens? We're sitting here, and let's say this asset had a 20-year life. Let's say the salvage value was 0. So the depreciable base was $800,000. We divide it by 20 years. How much is that per year? 800,000 divided by 20 is? 40,000. So I would debit depreciation expense. Would you say 40,000? I would credit the accumulated depreciation, 40,000. And then when I report that asset on my balance sheet, let me just make this into my balance sheet now. Equipment, 800,000. Accumulated depreciation, 40,000. Carrying value of the asset, net carrying value of asset is now 760,000, if I'm doing the math correctly in my head, which I don't like to do. If the discounted cash flows were 760,000 or more, no impairment. If the discounted cash flows were less than 760,000, we have impairment, and we would go ahead and take the loss at that time.
These are cash flows that you're somehow showing, or like
You don't show these. These are an internal analysis that the company does.
coming from that truck.
Correct. So what happens? Let's just do, say, one cash flow that's going to come from it in year 5. And let's say the cash flow that's going to come from it in year 5 is cash flow in year 5. Let's say that cash flow in year 5, CF year 5, and let's say the cash flow in year 5 is, I don't know. I'm just going to make up a number. It might not be very realistic, but let's say it's 900,000. Okay, but what they would have to do is discount that to the year that they're doing the analysis to see if there's impairment year 1. Because what happens? If you have to wait 5 years for 900,000, is that worth as much to you? You got to wait. If you have to wait, someone could say, well, rather than invest, $800,000 in this equipment, just put the money in the bank. And it would grow to this 900,000 anyway, rather than invest in an equipment. So to make the decision if I should take this 800,000 that I have, should I just put it in a T-bill, which is going to be a risk-free return, or should I sit here and take this money and invest it in this equipment? The only way you can make that decision is to take the amount you think you're going to get and do what? Based on the current interest rates, discount it to present value. And when you discount that to present value, let's say it discounts to an amount of 800,000. Let's make it 788,000. Well, at that point, you're saying, okay, well, since the asset has a net carrying value of 760, I don't have impairment. If you had done the discounted cash flow and the present value of that was 600,000, now I have impairment and I would have to write it down. Okay? So again, I want to get away from this notion. The point of this sort of riff off here is I want to get away from this notion that, the asset loses value as soon as you drive it off the wire. The company's doing this because they've done an analysis. I assume if, stockholders are willing to give them, money and buy their stock and so forth, there's some level of confidence that they have sat there and they have done some sort of analysis that says there's going to be future economic benefit to this asset that will be in excess of what they're paying for it. So we got a whole little enterprise going on over here. We got cell phones, we got interesting websites, we've got all kinds of spreadsheets and shit out. I'm more than happy to go home. You guys don't want to focus on this? My penalty is I get in my very nice frickin' car and I drive to my very nice house. So what are we going to do? We're going to stay in focus, or are we going to go home? That's the question. I'm waiting for an answer. I'll give you 10 seconds to answer. Then I'll answer for you. What? Okay, well then focus. Okay? If you don't want to listen to my answers, don't ask me scary questions. Okay, guys, we can go ahead and put the projector down. Okay, now, analysis. Now we're still kind of looking at external reporting here and what an analyst might use to look at a company. And there are tons of different analysis that could be done. I'm just going to talk about a couple of tools that are out there, okay? And we can be doing comparisons to, and we can do it intra-company, means inside the company. We can do an analysis inter-company, means comparing company A to company B. Okay, so there are various analyses you can do. And I mentioned a little bit horizontal, vertical, and then we'll talk a little bit about ratio analysis. Okay, now horizontal analysis, and I'm not trying to insult anyone's intelligence, means we do what? We go horizontally across the financial statements. Sometimes you'll hear this referred to as a longitudinal analysis, meaning we're going to look over time. Okay, so in this example, what we do is we're going to compare year 2 in this analysis, 2009, to year 1, 2008, and we come up with the difference between the 2 years. Then, to get the percentage change, you go ahead and you take the difference and you divide that by the first year in the analysis. So in this example, you would go ahead, you would put your cell phone down and stop texting, and you would go ahead and you would divide 75,000 by the first year in the analysis, the 945,000, right? Now the reason I ask you to focus is I didn't come to your house and ask you to take this class this summer. You came to me. Okay, so 75,000 divided by 945,000 gives me 7.9%. That's the percentage change. So we would go on so forth, calculating that percentage change like that. Now it's worth noting how you calculate that percentage change. I have had colleagues that I'll say, do a quick analysis and give me the percentage change of the dollar amounts being spent by this program over the last couple years. They'll walk out and go, okay, I'll do percentage change. They'll come back and they'll 5 minutes later and say, I don't know how to do percentage change. Okay? So it's worth noting the difference between the 2 years divided by what? The first year in the analysis gives you the percentage change. That's horizontal analysis. Okay? Now, you come over and vertical analysis is going to be going, not to insult anyone's intelligence, vertically down the financial statements. This is sort of a what? More of an intra-company analysis. We're comparing the company against itself. Okay? So what happens? We sit here and we look at our, I think it's, oh, they don't give it to us for the income statement, but for the balance sheet here, we have what? We have our total assets, and we want to see how much of that is made up of, say, current assets, current liabilities, and so forth, and we come up with these various percentages. We did that when I looked at Apple. That was a vertical analysis. Remember I said, well, look, their compensation expense is constituting, I think we said something like 25% of their total selling and administrative expenses, and it was something that you were able to add back to cash. This would be an example of a vertical analysis. Okay? Now, we have different ratio analysis we can do. And guys, there are a ton of ratios out there. And people do tend to get all hung up on, you know, things like EBITDA and all these different things. And my answer is there is no one analysis that, you know, is the key analysis. So there's a whole bunch of them out there. I'm just going to go through a couple of different ratios that I think might be useful. Okay, so let's talk about liquidity ratio. Liquidity ratio says, is the company going to be able to meet its short-term obligations? Okay, and a good measure of that is something called the current ratio, in which we divide the current assets by the current liabilities. We want this number to be what? Greater than 1. If it is less than 1, we have a problem, because that means they don't have the current assets to cover their liabilities that are coming currently due. Now, sometimes students will look at this and say, oh, okay, well then a current ratio of 15 billion to 1 must be great. No, because that then tells you, well, they're hoarding current assets, or maybe they're not collecting on their accounts receivable very well, and so the what? Current assets are building up. Receivable is a current asset, and they're not collecting on those. So we don't want it to be too high. I would say, you know, it depends on the industry, but something like a 5 to 1, 6 to 1 might be a nice, healthy current ratio. Okay? Yes, sir.
Is this dependent on the industry, or is it just for?
That's what I said. It depends on the industry, and so I just kind of stated generally. You know, there's no one right answer for this. I mean, there's no one right answer for anything, but yeah. It would vary by industry. Okay? Okay, good. Now, having said that, when we look at the account receivable turnover, this one, you know, does have some amount of, you know, consistency across industry. But we take a look and we take the net credit sales. Credit sales means sales that we made on credit, meaning we debited account receivable, we credited the we debited the account receivable, we credited the sales, right? Okay. Now let me ask you a question. What is net credit sales? How do you come up with net credit sales? Is that a hand up, or are you praying? Net credit sales. Huh? Say it again? Well, if it was total, why would it have the word net? What's net credit sales? The increase in asset, you debit. The decrease in credit. We're all the way back there. What's net credit sales?
Revenues a company generate based on credits.
Net credit sales. Huh?
minus the return or something.
Yeah! I mean, forget about credit sales. It's what? Sales, net sales is sales minus returns minus discounts, right? That was you guys. It looked just like you guys when we learned that in chapter 4. So net credit sales is what? Credit sales minus any returns minus any discounts, right? Did we give on those? So that's the net sales. What's the net receivable? What's net receivable? You know, if you're at, 18 years old and you're having short-term memory loss, I'd go talk to somebody. Okay? I mean, I have an excuse when I sit there and go, where's my clicker? Okay, there's a whole lot of things that I can't find anymore. I have to get up at 3 o'clock in the morning and wander around the house until I figure out where I'm at. Okay, but you shouldn't be to that age yet. Okay, the what? Net account receivable is the account receivable minus the allowance, isn't it? Okay, so we take what? We divide it by the average net receivable. Average net receivable is the beginning balance of the net receivable plus the ending balance of the net receivable divided by 2. Why do we divide it by 2 to get the average? Because there's 2 numbers in the numerator. If you want the average of 2 numbers, you add the 2 numbers together and you divide it by the 2 numbers. If it was 3 numbers, you would divide it by 3 to get the average, wouldn't you? Okay, so we just simply take the beginning balance of the receivable plus the ending balance divided by 2. Now look, that's this kind of an analysis of the average receivable. Would you do this to build a bridge? Would you measure the wind at the beginning of the year, December 31st, and then January 1st, and then measure the wind at December 31st and divide by 2 and say, there, that's the average wind that hits this bridge? If you did that, people would die. Bridges would fall. Things would collapse. Airplanes would fall from the sky. People would die. No one's going to die if we're not. So we sit there and we say, okay, this is the average net receivable between the 2 years. So we divide the sales by the average net receivable, and it tells us how many times we turn over the account receivable. Now, when I say turnover, I'm not talking about Apple. I'm talking Apple's turnovers. I'm talking about how many times do we completely collect on all of our receivable and then go out, have more receivable, collect on that, go out, have more receivable, collect on that. Now, it doesn't actually go that way, but it's an approximation of how many times we do that. So in this example, they've done this, 10.2 times. Then what we want to do is turn that 10.2 into days. How many days are there in a year? 365. So if we turn those receivables over 10.2 times, that means we're turning that receivable over about every 35.78 days in this example. Now, fear of the tree. If you have fear of the tree on your shirt, please raise your hand. Okay, what's your name, sir? Huh? Fearos?
Yeah.
Fearos the tree? Okay. Okay. So what happens? If you are talking industry, I mean, here it would be pretty consistent across industry, right? I mean, companies shouldn't be having to wait 60, 70, 80, 190 days to collect on the receivable. That's a little too long, right? So this could be consistent across industry to be in that 30, 35, 40 day range or so. So what happens, tell me again, I'm sorry, tell me your name, Peter, sorry Peter. Peter, what happens if this number is 180 days? What would you wonder? Let's say this number is 200 days. Let's say it's 300 days. What would you start to wonder? What would that indicate to you?
Maybe either the amount is huge when they split a long period of time, or they just fail and come from here.
Yeah, I mean, what's happening? That's meaning that what? This number is not coming down very well. And so what's happening? They're sitting there and it's doing what? It's driving up. So they're booking sales, but they're not collecting on them. How come? And as an auditor, we are required to do certain ratio analysis. And if the ratio analysis start pointing to things that make you go, now when I do my audit work, I'm going to focus my resources tremendously on this issue. Why is this happening? Okay. Okay, to your point, what if they're not collecting on the receivables, right? What's going on? Okay. Now, what happens? Inventory turnover. Okay, and here we take the cost of goods sold, divide that by the average inventory. Again, average inventory would be the beginning inventory plus the ending inventory divided by 2. And that tells them how many times did they completely sell out of their inventory to where they had to turn around and buy more items, completely sell out of that, buy more items, completely sell out of that, buy more items. Now, that's not actually how it goes, but that's what we are approximating here, right? Okay. Then we go ahead and we turn that into a number of days by taking the number of times they turned it over by the 365 days in a year, and that tells them how long things sat in inventory. This is how long things sat in inventory. Now, let me ask you this. Let's say it was every 159 days. If this was a sushi restaurant, would you want to eat there? Do not eat at a sushi restaurant that turns over its inventory every 159 days. Okay. What if it was real estate? Okay, that might not be as bad. So that one, what? And I don't know, don't somebody say, well, no, actually, if that's the case, I don't know. I'm just saying, I would think a piece of real estate might sit on the market a little longer than a piece of sushi. Okay, or stay in inventory a little longer, I should say, than a piece of sushi. So, it does have a variation by industry, absolutely. Okay, solvency ratio, is more of a long-term focus. It's similar to liquidity, but it's more long-term. And so the question there you could do, and it's the easiest ratio on the face of the earth to remember, debt to equity is the debt divided by the equity to see what percentage of the company is comprised of equity versus debt. And this number starts to get too big. That's an indication that the company may have some problems down the road in terms of being able to basically stay afloat as an entity long term.